While we've seen the housing market rebound nicely off the lows of 2022, there's a really good chance that you see the market continue to soften throughout the remainder of 2023. And that's largely due to two different factors. One is the economy, all the resilience out there in the economy, all the positive news when it comes to data, on top of the Fed continuing to push interest rates higher. This past week, we got news that first quarter economic growth was actually up 2% compared to the 1.3% first reported, which is a major GDP revision. And this is well above the previous estimate of 1.3% and 1.4% reported by the Dow Jones Consensus Forecast. And that's because the US economy showed stronger than expected growth in the first quarter, largely due to upward revisions in consumer spending, which actually rose by 4.2%, which is the highest quarterly pace that we've seen since the second quarter of 2021. On top of that, we have US consumer confidence rising to the highest levels that we've seen since early 2022. While at the same time this week, we saw jobless claims plunge by 26,000 jobs, which is the largest drop we've seen since October of 2021. So by just looking at the data, it looks like the economy is really strong. And during the same time, we're seeing one of the key inflation measures, the PCE, which is primarily what the Fed has used in the past to measure inflation, meet the consensus expectations, rising by just 0.3% month over month in May. Now, year over year, we're seeing the core PCE rise by 4.6%, with the headline PCE number sitting just under 4% at 3.8. So what we have here is positive economic data. We have positive jobs reporting, and we have data that shows that inflation is decelerating. But with that, Fed Chair Jerome Powell is saying that at least 2 more interest rate hikes are likely needed to bring inflation down to the central bank's target of 2%. And that acting at consecutive policy meetings is not off the table. So basically what they're saying is there's a chance that they might hike those 2 different times in back-to-back meetings. Because Powell says we likely need 2 or more rate hikes to cool inflation, and that more restriction is coming. And now it looks like the market is starting to get on board with that as well, as we're starting to see bond traders heeding Powell's pledge to stay on the Volcker path. And for those of you unfamiliar with Volcker, he basically kept his foot on the gas pedal, more or less slamming the brakes on the economy, taking interest rates up to 20% in order to stop inflation. And with that, interest rate traders at the moment are expecting an 87% chance that the Fed is going to hike by at least 0.25% at the July meeting, with another 20% expecting that the Fed will hike an additional 25 basis points at the September meeting. And Morgan Stanley is more or less in line with those same thoughts, as they see the Fed hiking in the July meeting after their speech. So when you hear the economy is doing well, you hear that the Fed is going to hike rates because it's still doing well. What are your thoughts? Where do you think the economy is headed? Do you think we have this strong, resilient economy like is being reported in the data? Or do you believe there's a lag and that the data might actually be worse than what's reported? Or maybe even you're a conspiracy theorist and you think the government is completely lying about the data? Let me know in the comments below. I'd love to know what you think. So how will this actually affect you as a first-time homebuyer, as a homebuyer in this market, or potentially even a seller in this market? Well, as I mentioned at the beginning of this video, I think the second half of 2023 is likely going to be a cooling for the housing market, and it's primarily due to housing affordability and a lack of supply out there in the market. In fact, we're already starting to see a little bit of cooling in the market, with pending home sales down 2.7% in May, on top of interest rates now peaking above 7% once again. But on the flip side, we actually saw new home sales surge by nearly 20% from just over a year ago. And one of the main reasons for that is because new home sales now make up nearly 25 to 30% of the available homes out there in the market. So if you're a home buyer out there looking to buy a home, there's a really good chance that new inventory may be your best bet, because in many cases, those new construction communities offer more inventory, on top of many of those builders being willing to work with sellers by paying down the interest rate, by doing incentives in order to get buyers motivated to make a purchase. And with that, we've seen mortgage demand grow primarily because of new home sales. But on the flip side, we did see U.S. home prices post its first annual decline since April of 2012. But fortunately, it's not the crash that everyone was expecting. We saw a drop by 0.2% year over year. So more or less, home prices have stayed flat during that period of time. And the primary reason is because housing inventory is so tight in the US that it's provided price stability for the markets out there. Because we always talk about the real estate market being driven by supply and demand. While demand is low, inventory is also low. So they're more or less balancing each other out, which is keeping those price declines in check. Now, before we go any further, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It helps the YouTube algorithm push it out to more people and helps me accomplish my goal of educating home buyers and sellers. And if you like information like this, do me a favor and hit that subscribe. Now, here's the issue. Everybody out there believes that more homes being built is essentially going to solve the problem with the housing market. And while I do believe that is a part of the solution, because we do need more homes on the market, what we really need is more affordable housing versus more homes on the market. And that's because a lot of the homes that are being built are expensive. And building those types of homes don't actually solve the problem, because a lot of the housing that's really, really needed is at the lower end of the price scale. And going back to what I said earlier about the housing market more or less softening throughout the rest of the year, the reason I believe that is because I don't think we're going to see a major move in inventory, and I don't think we're going to see a major move in interest rates that would more or less improve affordability. What I see more than anything else is I do see the economy continuing to soften. I know there's a lot of positive news out there at the moment that's being reported in the headlines that make it look like the economy is much stronger than it is. And that's probably why Biden is saying that he believes the US economy will likely avoid a recession. But what I like to do is go back and look at history. Historically speaking, the Fed never admits that we're in a recession until we're actually coming out of one. So while a lot of the news out there is still reporting positive, they have even admitted that we haven't seen the full effects of the interest rate hikes that they've already put in place. So once these hikes settle into the market, you're going to see the economy slow, which means less consumer spending out there, and in turn, less inflation in the market, allowing the Fed to back off their hawkish stance. And as we head into a recession, they're likely going to do some sort of quantitative easing by not only stopping interest rate hikes, but likely cutting rates. But with that, I don't think that's likely to happen in 2023. It's probably going to be 2024. And while I do think interest rates are going to improve, I don't see any significant changes happening anytime soon. So I think you're going to see a lot of what you've seen over the last 3 to 6 months, which is interest rates go up a little bit, and then we get some bad news in the economy, and interest rates go down a little bit, and vice versa. And during the same time, we're likely going to see inventory peak in the next couple of weeks, which means that as demand slows because interest rates are staying high, inventory is likely going to slow as well, which is going to continue to keep those two in balance and keep home prices stabilized. But one thing I want to be clear on is that you're going to see more and more negative reports when it comes to housing, because we're still doing year over year comparisons. And with that said, 2022 was still a hotter housing market than 2023, even with the rapid increase in rates. So just make sure when you're out there looking at data and paying attention to it, you understand what you're looking at and not just looking at part of the picture. You're looking at the full picture, because there's a lot of people out there that leave things out of videos and comments because they're trying to push their narrative. So with that said, if you're looking to buy a house, in no way do I think that housing prices are crashing and you're going to get some crazy deal here in the next couple of months. At the same time, I don't see housing increasing by any substantial amount either, so I don't think there's a real rush to go out there and buy a house today. But what I will say is that over time, it pays to be a homeowner, not only in paying down the principal, but getting appreciation, tax benefits, everything that comes with that. So if you're considering buying a house, just make sure you have a longer term time horizon, you have money in the bank, you're comfortable with the payment, you have job security, and more importantly, it's the right time in your life.